And now I'm expecting all.
Well, hello everybody, and welcome to the Q2 quarterly download. If you didn't recognize that tortured voice, that was Bob Dylan, and the title of that song is called Things Have Changed, and that's sort of the theme today, things have changed. Before we get into our presentation, I want to we love to get feedback from our viewers, and we'll get several hundred people watching this video after we did the live session yesterday. And we think that there are certainly some challenges, in the real estate market with interest rates rising. We think that first challenge is going to be in condo development uncertainty and maybe single family home construction uncertainty. And what we're suggesting to developers is that they consider pivoting their condo or for sale development to rental development. And we're going to run a seminar August 4th for probably 90 minutes on this topic. So if you had any thoughts on that idea, good idea, bad idea, what questions would you like answered? What guest would you like to see? We would love to hear from you. Very much appreciate it. For me, you can just email us at the contact information that you probably already have or that will come up at the end of this video. Okay. All right. Thank you. All right. So let's go on to today's topic. And today's topic is things have changed. And things have changed very rapidly, and we don't really know exactly where we are right now. And it almost feels like the same thing that happened during the shutdown. So, when COVID-19 happened, so all of a sudden things were shut down. It was a new sensation, and it felt like life was in a fog, or our heads were in the fog. And this is the analogy I used to talk about, how you have to think about the marketplace, and lo and behold, the same things happened again now, 2 years later. So you're flying an airplane and you're in the fog. Okay, you can't really see ahead, but you got to keep moving because you're an airplane, right? If you're a ship, you could just drop anchor and stop, right? So you're flying. At some point, the fog clears up, or you decide to drop out of the fog. And when you drop out of the fog, what you see may be different than what you think. So let's say you're flying from Toronto to Europe, and you're flying across the Atlantic Ocean. You drop down out of the fog, and there you see the beautiful green island of Ireland. Okay, if you see beautiful green, things are good, right? That's one option. You could drop down out of the fog, and there could be a mountain in front of you, right? Big mountain or small mountain, right? It's another option. The other option is you could drop down out of the fog and still just see more ocean. So it's not clear as to what's going to happen. And because this interest rate increase has only happened in the last few months, and because apartment data takes 6 months to collect in terms of transactions, maybe longer, right? We don't really know what the impact of this is. And so when there's no data, sometimes the only data you have is sentiment. How do people feel? How do people think? And so on. So I've had hundreds of conversations in the last 3 months with people gauging their opinion, and some of those things I'm gonna talk about here, right? So I think it's fair to say that things have changed, and what's changed is interest rates. And it's kind of amazing. We all knew interest rates couldn't be this low forever, right? It had some serious problems in terms of currency situations, currency problems, had serious problems with inflation. You print all this money, of course there's going to be inflation, right? So interest rates have risen already. They've doubled to some extent, and interest rates are going to continue to rise, right? Real estate is the place that's going to see the impact probably first, because it's a business all about leverage. So it's going to show up first, I think, in terms of condos and single family home sales, and maybe in the closings, because if investors bought the condominium 2 or 3 years ago, and they expected interest rates to be 3%, and now interest rates are 5%, that's a very different financial outcome for them on their monthly carrying costs, and so on. So I think there's going to be some dislocation or some disturbance that's going to occur in the condominium market. Nobody knows for sure because it's still early, but there are cancellations of condominiums and cancellations of subdivisions of homes and things like that. It's probably fair to say that the sales volume has dropped, and in some cases I'm hearing that it's dropped dramatically. We're going to know more now, and there's no published data on this, but talking to clients, that's what we're hearing. Now, if you think about this a little more detail, the problems might be different depending on which asset class it is, which location it is. Let me give you an example. If I bought a condominium as an investment 3 years ago or 4 years ago, and it's just coming to market now, then I've got 3 or 4 years of appreciation. So if the market drops 10% or 20%, I'm still whole. I'm still above the price that I paid it at, that I paid for it 4 years ago. And then you know what? Maybe I'm going to close. Maybe I have no problem closing, right? But what if I bought a single family home that takes a lot less time to build? It takes, let's say, a year to build. Now I've only got the cushion of a year. So if the market's gone up 15%, but in the last year, and then it dropped 20%, well, now I'm underwater. So maybe the homeowner or the guy who bought a single family home is not as good, is not the same flight risk, okay, as someone who's bought a condominium where they've got, where they've got a lot of time, right, to get appreciation to offset any decrease that's happened. So what happens to interest rates? Well, I think the prevailing thought is, and nobody knows, nobody's a crystal ball, but that, the damage has already been done to the long end of the yield curve, meaning that interest rates have gone up both on short-term mortgages, 5-year mortgages, and 10-year mortgages. But there's a general feeling that the interest rate increase is the sudden interest rate increase is going to be temporary, and the purpose of this is to bring inflation under control. The problem is, as you raise interest rates, inflation doesn't come under control, assuming it will immediately. There's a 6-month lag time. So there's the belief out there that we'll raise interest rates and they're going to overshoot, right? And then that hopefully will bring inflation under control, but it may put us into recession by doing that. Common sense. Well, if we go into recession, then the thing would be drop interest rates to kind of stimulate the economy a little bit. It's a tricky job for the governor of the Bank of Canada for sure, right? So interest rates are definitely changed. They continue to change, and I think nobody knows the outcome. But what I just presented is a reasonable scenario that the damage is going to continue on at the short end of the yield curve, but the damage has already been done at the long end of the yield curve. Apartment owners are typically very long-term investors, and so they will look past this and not see the damage maybe that a short-term condo flipper or single-family home, investor or something like that would make, right? Number one. Number two, cap rates. This is the big story here, because what's going to happen to cap rates for apartments, for existing apartments, as well as for newly constructed apartments? Well, let's do an analysis or talk about cap rates. Cap rates are driven by 3 factors, and everyone thinks interest rates drive cap rates. They do, but they are not the number one driver. So if interest rates go up, it does not mean cap rates go up. Okay. So what's the first driver of cap rates? Well, it's buyer IRR expectations or buyer 10-year IRR expectations, right? So if buyers believe that the world is confusing, the world's a mess, and they want safe assets, then they're going to buy, then they're going to want apartments, and they'll pay more for that apartment for its safety and its stability. So apartments have the lowest cap rates of really all asset classes, and it's because of the stability, not because rents rocket. Sometimes they do, but it's because rents don't go down, vacancies don't spike up the way that hotels could have problems or office could have problems, in a recession. Apartments are recession proof, and apartments are COVID proof. So the number one factor that drives cap rates is investor IRR sentiment. So if investor sentiment towards apartments remains good, cap rates will not go up as much as people think. Okay, so apartments are stable, Canada's stable. So my point I'm making here is that apartments are stable, Canada's stable. Maybe cap rates won't go up because investor sentiment remains bullish on apartments. That's the number one factor, and it has the highest correlation, okay, to cap rates. Okay. Number two, the second factor that drives cap rates is rent growth. Okay, so if an investor believes that rents are going to grow in the future, and especially on new construction, right, where you can raise the rents every year to the market, if you believe rents are going to grow, then you're going to pay more for that property because of the future rent growth, right? So if you have an apartment building in a town where the mine is going to shut down in 2 years, well, there's no rent growth in that town, but rents are going to go backwards, right? You're not going to pay a higher cap rate for that property. But if you're in a barrier to entry market and there's not a lot of supply coming, because with interest rates rising, condo rental projects are being canceled, yet immigration is going up. So the one story that I think almost everybody agrees on is that there will be rent growth in Canada. there will be rent growth in Canadian cities because of those factors. So if you believe rent growth is going to be good, then you will pay a lower cap rate, and that's very positive for apartment prices, right? So first factor is investor IRR expectations. The second factor is your belief in rent growth. The third factor, and it's third in order of impact, is interest rates, okay? And interest rates certainly have an impact on cap rates, but it's not a one-to-one ratio. We've seen data out of the US. It shows that there's a 0.62% correlation between interest rates and cap rates. So and this comes from Witten Advisors, a highly respected economist in the US, and they said that the correlation is 0.62, that when interest rates go up, cap rates also turn up. They're not saying how much they turn up, just the fact that they actually turn up when interest rates go up. It's not 100% when interest rates go up, cap rates go up, and they do not go up lockstep. So a 1% rise in interest rates is not a 1% rise in the cap rate. It's less than that if indeed it'll go off, and that can be offset by rent growth and be offset by investor sentiment. So it's an important thing to understand that cap rates are not tied to interest rates. They're tied to a series of factors here. Okay. The third thing is I want to just give you a sense of investor sentiment. So what are people thinking? What are people saying? Well, we're apartment brokers. That's all we do is sell apartments and do feasibility studies on new apartment construction. So on the new apartment construction side, we're having a lot of lenders and developers coming to us saying, does the deal still pencil out? So we're rerunning the feasibility study and the pro forma that we did 1 or 2 or 3 years ago. And what we're finding is really quite interesting. The news is not as bad as everybody's saying. Yes, construction costs have gone up, okay? But rents have also gone up. And a lot of that construction cost increase is being offset by the rents going up. Now, interest rates are still a factor for sure, right? For the long-term owner, that's going to impact on the pricing. But if condo projects and rental projects are being canceled and contractors are now coming back to you who said, wait, we're busy for the next 2 years, they're coming back and saying, we're not busy for the next years, you could see construction costs maybe come down. In fact, I think a lot of people expect that they will come down. So now construction costs are up, rents are up. Rents will stay up and construction costs will come down. And if you look at the long term, the long end of the yield curve, that's where there's less damage. So the story for apartment development is complex. It requires deep financial analysis, some thought on what could be some of the what if scenarios, right? The other investor sentiment comes from buyers of apartments, and then this is quite interesting. A year ago and 2 years ago, everybody said to us, bring me the building with no financing on it, because then they would take it to CMHC and get low interest rate, under 2% financing for 10 years, and boom, you just sort of locked it up, right? And so that's what everybody wanted. Today, everyone says, don't bring me a building with no financing on it, because I don't want to put 4 or 5% financing on it. Bring me the building that had financing on it last year. Fair enough. So they want the building where the owner put long-term financing on it for 10 years, and now they want that low interest rate, because if they buy it this year, they're going to have 9 years left on it. So that's kind of interesting that investor sentiment has just flipped completely upside down. I think that today, because of interest rates and where REIT yields are, that the REITs are probably on the sidelines for a while for any deal that has no debt on it, because they're not going to buy a building at a 3.5 cap if interest rates are 4.5%, right? So I think that yield investor is probably sitting on the sidelines and waiting to see what happens. And as we started talking to people, it became really clear that there are 2 types of investors. There are yield investors and there are value investors, right? So the yield investor says, I'm going to buy an apartment building, I'm going to buy cap REIT shares. And let's say cap REIT shares are paying 4.5% today, a yield, right? And so if that investor gets 4.5% from cap REIT, then they're happy because it's safe income, right? Relatively safe. If all of a sudden Canada savings bonds pay 5%, right? That cap REIT guy is going to say, wait a minute, I came here with a 4.5% dividend. I could get a 5% yield from Canada savings bonds with 0 risk, right? And they might leave. That's because they don't love apartments. They're not fundamentally apartment people. They are yield people recognizing that apartment yields are attractive to them. Okay, so that's what I would call the yield buyer. Then there's the value buyer. The value buyer, I think, could be a private family. So they've got a portfolio that's worth $100 million. Okay, today's current price might have been 10, 20 years ago, cost a lot less money, right? But it's worth $100 million today. Oftentimes, those portfolios are throwing off a relatively low yield because the cost of operating the building and all the capital expenditure work that's get reinvested in the building. So if you've got a $100 million portfolio, you might be throwing off $2 million a year, which would be a 2% yield, right? They say, well, wait a minute, you're getting a 2% yield. Why don't you just trade those apartments and buy $100 million of cap rate, right? You get a 4.5% yield, or buy Canada savings bonds. They're not going to do that because they're apartment people. They're value driven, they're real estate driven, they are tax efficient driven. They are, I own something, I couldn't rebuild it that for $100 million, that would cost me $200 million to build. They're real estate people, right? And so I believe that the people who are fundamentally real estate people are still at the table to buy. They may be keeping their powder a little dry to see what comes. But we've got 4 buildings in the marketplace right now. And in these last 2 weeks, they have gone under contract. And they have gone under contract at pretty fair prices relative to, before interest rates went up and before this happened. So it's going to be an interesting time. There are fewer buyers in the marketplace probably, but there's still strong buyers, and I think deals will happen, but they're going to take longer. They're going to be harder. Brokers are going to have to work harder. Investors have to, just maybe temper what they think is going on. Sellers have temper, but the spread between the bid and the ask is high, but it ultimately always comes down. So what's the road ahead? Well, who knows, right? We still, next slide, next point here. What's the road ahead? Well, I think that there are many problems that we're facing right now with interest rates, supply chain, a looming recession, and things like that. But the thing about apartments, I've been in this business for 36 years. I've probably been through, 17 recessions. I moved all over North America doing the work that we do. And, if there's ever an apartment building in trouble, it's usually never the apartment. It's the person or the partnership or the company that has a problem somewhere else that, they start taking money out of the deal for some other problem and so on. But apartments do well. That's why the cap rates are where they are. And I think that there's not going to be a lot of blood on the street in the apartment business here at all. There almost never is. There may be some challenges in new apartment construction, but that's not a huge business. So I think the road ahead is, batten down the hatches a little bit, but I think things are going to be fine. They almost always are fine, right? So we're going to do a couple of things before we wrap up here. So do you want to just play the next video? So we ran our annual conference June 16th and 17th this year at in downtown Toronto. This is a short video on it.
You'll leave here with actionable knowledge.
Yeah, Derek and his team have taken all the time in the world to research the sector, better than probably anybody else in Canada.
The demand for rental housing in the next 2 decades is going to be almost unmatchable. You need to educate yourself, position yourself best to take advantage of that opportunity, and I think this is the place to do it.
This is what the public wants, and if we don't provide this, we have to answer to that.
We need homes for these new people. Our kids need homes. We have no homes. Now is not the time to be humble. If we're going to lead a charge of change, now is the absolute opportunity because there's a housing crisis in the country.
Well, by the way, the pictures of the food and drink were not stock photos. Okay, that's the food we eat, and that's how much we drank. It was really two really good days. These seminars are designed for the apartment developer. We keep the attendance limited to 50 people. And I think the interaction amongst the developers, I think, is fascinating to watch. We had developers from across Canada attend. So if you're interested in that, we booked next year's date, June 7th and 8th of 2023. Okay. Next slide. So we've launched our learning portal. This is something that we have worked on for 2 years. We have taken all our amortized knowledge and put it in a format for developers to access when they want it. So we're not coming and saying every week we're teaching a course. It's all there. If you're in the middle of lease up, you want the lease up information. If you're in the middle of buying land, that's there. If you're doing a joint venture, that's there. And it's detailed and it's in many formats. It's in book format, it's in video format. There are contracts there, there are tools there, and then we'll also consult with you on a quarterly or monthly basis to help you through the whole development process. Our goal is to turn hundreds, thousands of people into apartment scientists to start building apartments. If you're interested in that, contact us. We'll give you a demo of the service. A couple of things coming up. We're doing webinars. Okay, so we've got two new books out in the marketplace. You can buy them from our webpage, or you can go to Amazon and buy them. The hardcover books, The Intentional Apartment Developer. It's about a 260-page book, and we've taken a lot of our amortized knowledge that we've gained over the last 35 years and put in this book. And this book, it really is written generically, and it can be bought anywhere in the world. We've had sales in Europe and things like that of the book already. The other book is a private developer's roadmap for building affordable housing in Canada. Part of our conference was about the housing shortage. We think there's a huge business opportunity for Canadian developers to to build apartments. So if you're interested in that, our webpage or Amazon, and that book will be sent to you. Okay. Okay, Sarah, next. We start one of the sessions that we did, and it'll be posted on my LinkedIn and posted on our web pages. We talked about why developers live longer, and we think that, and this is not a business thing. This is something we do because this is what we do, help our clients. We're going to start in the fall every Sunday morning. It's second Sunday of every month. We're going to run a session on developer longevity and the things that you can do, particularly aimed at developers, so that you can live longer lives so you can build more apartments. Okay, it's next slide. It's great that you joined us. Thank you very much. Our goal on these quarterly downloads is to talk about things that nobody else is talking about. We're not recycling data or paper or things like that. What we want to give you is timely information coming from the marketplace that's ahead of the curve, looking at gaps in the market. Okay, so our next download is Q3 will be October 4th. Mark that date in your calendar. We do it at 10:30 Eastern time. The first half hour is just like, come on and just chat with people. We call it Coffee with Derek. We talk about stuff, and then 11 o'clock is the formal presentation. This is the recording of that formal presentation. I don't have a topic for Q3 because I think the world is changing so fast but it's certainly going to be on something that's going on in the marketplace. So thanks very much for joining us. And for more information on our company, connect with me on LinkedIn, and certainly go to our webpage where there's a lot of information. Thank you.